Right, welcome to the show. Good morning. Good Wednesday morning, I believe. There we go. 30 minutes to the opening bell here in Hong Kong, in Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Bell.
And our top stories: market caution ahead of the US CPI print and Fed decision. China's May inflation numbers out in 30 minutes, set to show the pulse of demand remaining faint.
Now, also ahead, Bloomberg reveals that Chinese regulators are considering tougher restrictions on how banks sell hedge fund products to the public.
And another scoop to bring you as the US weighs further curbs on China's access to cutting-edge AI chip technology.
Plus, Segantii Capital and its founder Simon Sadler is set to face a Hong Kong court on insider dealing charges. We'll be outside the court live this hour.
All right, quick look at the market action this morning. And Dave, we're using the GMM function here really just to indicate that there's not a whole lot of activity going on just now. Given the sheer number of events that are coming up, you've got the US inflation print ahead of the FOMC decision, US inflation numbers, as we said, due out in about 30 minutes as well. So really that big countdown to these key economic indicators and what they're going to tell us about inflation pulses in a variety of different markets. But here you've got the action, a couple of different ones just coming online. Taiwan, Singapore among them here, but so far fairly steady going in the session. Bonds as well, you're just seeing that slight retreat coming through in yields. We did see that stronger Treasury auction overnight. It tells us that perhaps the US inflation numbers could give the Fed a little bit of breathing room and set the stage perhaps for cuts possibly toward the end of the year. But that's the state of play there. Geopolitics, of course, never far from the headlines. And one story we're tracking in particular today, if you just change on now, is a Bloomberg Scoop, actually, that we could actually get further restrictions on China's access to AI chips or AI chip technology. We did actually see the likes of NVIDIA, AMD, Intel as well declining on the Wall Street session, not really showing up so far. Though we are watching TSMC, of course, one of the key ones has been named in that scoop. Let's change on as well because we are counting down to the open for China today. And again, the outlook here, fairly steady. We actually did see a pretty big drop for the Golden Dragon Index overnight. But Dave, as we said, really, there's just so much that investors are still awaiting for in terms of the numbers.
Yeah, over the next 12 to 16, even 24 hours, if you consider, of course, the Fed at the end of that dark rainbow, as they say, in terms of the risk appetite. So, yeah, I mean, volumes, as you point out, Bell, were on the weaker side of things. We are expecting to see that on the lighter side as well when these greater China markets open up in about 30 minutes from now. That being said, we are also seeing some downside momentum, particularly onshore. In fact, you know, when you look at both benchmarks, Shanghai Comp, CSI 300, we're back to levels of late April, a little bit more. We're back to levels of mid-April. In terms of volumes coming through, watch that very closely. We're in a 4-day skid as far as the CSI 300 is concerned. And then we have inflation numbers coming through as well, maybe showing, if you look at these forecasts, showing a weak impulse around price pressures in mainland China. We are in the window for some data from the banks and the PBOC and credit creation that could come out today or as early as today. In terms of sectors to watch, so on certainly some of the reporting we've done here at Bloomberg, some of the chips, of course, EVs on the back of these expected higher tariffs that could come maybe by today out of Europe. And, of course, we're live out of the court here for the Segantii hearing, of course, and a colleague will be standing by for that as well. Not on your screens, I should also mention, there's a bond auction today, around 280 billion renminbi in CGBs, two different tenors. We should be getting the details of that sale in about 90 minutes from now. But in the meantime, among the many Bloomberg Scoops we have, let's talk about this hedge fund story.
Yeah, well, actually, Dave, I was just checking what's being the most read over the last 15 minutes or so, and it really is this story that's just shooting up the chart since it was pushed out about 30 minutes ago. But Chinese regulators, they're said to be considering tougher restrictions on how banks sell financial products to the public. Greater China Senior Executive Editor John Liu joins us now with more on this Bloomberg Scoop. And John, what's the purpose of this exactly, cutting off what's been a very major distribution channel?
So you'll remember last month, Chinese authorities actually began an investigation into a relatively large hedge fund in Zhejiang province. It was managing about 2 billion yuan in assets. It was accused of breaking laws and other wrongdoings. There were reports that they had stopped paying clients who were trying to redeem their positions in that hedge fund. And so that has caused a lot of concern among regulators that potentially with all that's happening in real estate and the other parts of the economy that are facing various challenges, that there might be other hedge funds that end up exploding, taking investors' money, other wrongdoings exposed. And so they're going after this funding channel that has been used by hedge funds. Banks across China have been selling trust products, and then those trusts have in turn taken that money and either gotten hedge funds to manage it or invested it directly into hedge funds.
So, John, at this point, what do we know about where we are in this process? Are we still in the consultation phase? And just give us a rough timeline of what we're talking about potentially here, if at some point we do get, of course, this ban at the end of this rainbow.
So what we understand is that the regulator has sent these new regulations to the industry for feedback. And so we are in a consultation period, but the expectation is that these rules will come into effect.
John, thank you so much. Sean Leo there in Beijing for us, getting us up to speed on this Bloomberg Scoop. You can check that out, of course, on your Bloomberg terminal. The other big story we're tracking this hour is this court hearing, of course, that's taking place today. Segantii Capital and its founder, Simon Sadler, are set to appear in a court here in Hong Kong soon to face insider dealing charges. Let's bring in Min Min Lo, our China correspondent, joining us outside, of course, the city's Eastern Magistrates Court, where, of course, things are about to, if not already starting and beginning. Yeah, Min Min, I'm not sure if you can hear me. Yeah, and hi to our cameraman as well, since I believe you're just doing a back and forth there. What are we expecting to see today? Okay, yeah, Min Min, if you can hear me, what are we expecting to see today?
We actually just saw. Yeah, I'm at the courtroom. We actually saw just some of the lawyers going into the courthouse earlier. A lot of reporters staking out here. We're looking out for the defendants, waiting for them to arrive. The hearing is supposed to start in less than half an hour's time. We're not expecting a long trial today. Our sources are saying that the SFC, the Securities and Futures Commission, are likely to push this case up to the district court. The district court will be able to hand out longer sentences of up to 7 years, as opposed to the maximum 3 years that the magistrate court can hand out. But that's still below the maximum penalty of up to 10 years in prison for an insider trading crime in Hong Kong. But our sources are saying that the SFC is not looking to escalate this case all the way to the High Court. Now, the defendants, they were here on May 2nd. They did not enter a plea. They both posted bail. Simon Sadler, the founder, had posted a 1 million Hong Kong dollar bail, and his former trader, Daniel Rocca, he had posted a $500,000 Hong Kong dollar bail. So we want to look out for, if all things go according to plan, whether they can extend their bail on the same terms or whether there will be harsher terms, and also when the next hearing will be at the district court.
And Min, what are the legal arguments that are going to be made in this case? What are we expecting from the prosecutor's side?
Yeah, the legal arguments will likely center around exactly what kind of information Segantii had gotten hold of prior to a block trade that happened in 2017. So the SFC has not identified the block trade, but the Financial Times have said that this is related to a sale of a 10% stake in the fashion retailer Esprit, and that sale was carried out by another hedge fund called Lone Pine Capitals. Segantii had allegedly obtained insider information from a former Merrill Lynch banker, according to our sources and according to the FT's reporting as well. And they had traded ahead of the block trade in June. And our information from the Bloomberg terminal shows that there were unusual price movements on Esprit's shares in the days leading up to the block trade. The shares had fallen by about 3% in each of the 2 days ahead of the block trade, and it had fallen 13% on the day of the block trade. And in all, Esprit had lost nearly 30% of its share value in 6 consecutive trading days. But again, the SFC has not revealed all these details yet, so there is a lot of uncertainty, and it depends on whether the prosecutor side can find the evidence to prove that Segantii had traded on material, non-public, market-moving information.
All right, something certainly going to be very closely tracked in the city today. That was our China reporter, Min Min Lode, there from Hong Kong's Eastern Magistrates Court. And we will, of course, Dave, have a very big guest coming up in the next hour on this hearing from a former Hong Kong SFC enforcement officer or enforcement division director. But coming up, we're also live from Sydney and the Morgan Stanley Australia Summit. Our colleague Heidi Stroud-Watts is there. Heidi, and of course, you're also speaking to a lot of big guests ahead.
Yeah, Belle already had some great conversations, including, of course, chatting to the Australian Treasurer Jim Chalmers in the previous hour, particularly ahead of the Chinese Premier's visit this weekend. But as you say, in this hour, we'll be speaking to the Chief Global Economist for Morgan Stanley, Seth Carpenter, will be joining us. And, you know, they really see global growth as remaining quite stable with a period of sort of mild disinflation in their forecast across 2025, much like the first half of 2024 is how they're gauging next year to play out. They say that tight monetary policy should continue to slow growth even as these rate cutting cycles march along. And it's a perfect time to be speaking with him, given that, of course, we do have the Fed and the BOJ. We'll also be talking about what this rate environment means when it comes to VC investing. Paul Bassat from Square Peg will be joining us shortly too.
All right, welcome to the show. In just under a minute, we should be getting the renminbi fixer today at about these levels on dollar offshore. I'm looking at my screen, 727.25. We are flirting with the weakest levels of the year on offshore. We are already there on the onshore rate, so watch it closely as this breaks. But of course, a lot of other stuff is happening these next few minutes and hours and day.
Yeah, no, there's obviously a lot on the agenda. You've got, of course, China inflation numbers due in about 15 minutes from now, and certainly going to be watching, at least from the PPI side, and we're going into deflation for a 20th straight month here. But also inflation numbers, not just from China CPI, but the US ones as well. And what does that mean for the Fed? This is a very pivotal meeting that we're going into. And are we going to get any sort of indication around when we can start to see this expectation of rate cuts, at least on the horizon? But it was interesting to note as well, because we had that bond auction overnight, and we actually saw really strong demand for it, even though you're ahead of these very volatile events. But let's get more on that now. Bring in Vanessa Chan. She's head of Asian Fixed Income Investment, directing it at Fidelity International. And were you watching this bond auction quite closely, or did it tell you anything about the sort of demand that we're seeing in the market right now?
Yeah, I think there's a few data point or event that's going to hit fixed income investors this week. I think there's the CPI number, there's the Fed meeting tonight, and there's additional kind of bond auctions coming through as well. So that's probably certainly create data points that investors will be looking at. If anything, we're probably focusing on, at the moment, the CPI number and the Fed actions. But yes, the auction does give us some indication in terms of where investment appetite are as well.
Yeah, I was also looking at, and I couldn't understand it. So there was a strong auction. I think the bid to cover in that was about 2.5, which was the highest in about since 2022. We've also seen open interest. Sorry, I'm getting geeky. Open interest on the 10-year futures down about 80,000 contracts. So there's some bullish calls getting taken off the table. My question is, how do you think markets are positioned ahead of CPI and the Fed?
I think investors are probably looking beyond just a number. Okay. I think if you're kind of paddling a little back, we see inflation kind of pivoted. It's probably not as low or reaching the target, if you would, that the Fed would expect to move on to a cut. But the kind of immediacy or the kind of distance going into a cut is much closer. I think that's one. If you look at the dot plot, you'll see that this year the market consensus is probably 1 to 2 cuts. A lot more depends on the timing. And kind of what does that mean for fixed income investors? Yeah. What it really means is that if you look at some of the history in terms of before and after rate cut, 6 months before rate cut and 6 months after rate cut, you see that some of the U.S. Treasuries, U.S. investment grade, do actually provide relatively strong returns. So that's probably in a hindsight giving you some indication in terms of why there's that kind of gradual building up in terms of that bullish view towards some of these auctions as well.
In terms of your positioning, though, and the size of the bets that you're making here, would you say that they've come down, or do you have more conviction around that?
Yeah, I think we've been kind of neutral, slightly overweight on duration in general for our fixed income funds. We also taking a bit more kind of tactical positioning on some of the local currency duration. So, for example, since the beginning of the year, some of our fixed income funds do have added a little bit of the European duration, which when the rate cuts happen, it does provide a very attractive return. In Asia, there are some tactical opportunities available on the local rates market, but that's really important that we work very closely with our trader to capture some of these opportunities. Size of the bets tends to be still quite nimble, if anything. That's probably on the back of some of the interest rate volatility that we've all seen for the past 2 years as well. So it's a little bit of a balancing in terms of risk and reward approach when it comes to duration trade.
Okay, now can we at least, so the timing is up in the air still on the Fed, but most other central banks have started to cut, the ECB, and of course we might get, of course, others as well. Can we make that assumption that peak rates are behind us, to your point on duration as well, and can we take advantage of all-in yields, which tempting at the start of the year, but if you did that, though, you'd get burned?
Yeah, I think if you look at the all-in yield, it's still very attractive, particularly when it comes to the investment grade space or even kind of high yield space, which is why you've seen the kind of bond market rallied quite strongly as well. And I think ultimately investors will need to be cognizant in terms of what they're looking for. If they're coming in looking to lock in yields, then yes, it's still kind of being attractive, particularly on the kind of shorter and high qualities. But then if investors were saying, okay, should I be thinking about duration? Then they probably need to take a slightly different approach and start nimble and add on duration. There's also pockets of markets that has been performing quite well. Asian high yield, which you'll see for the past couple of years, I would say unloved. That's probably a function of China property. The percent of China property used to be a lot higher, and now you're probably kind of below 5% or even lower when it comes to China property and Asian high yield. Year to date, I think if you look at the index level, it's probably giving you high single-digit return. You still have a very attractive yield component coming through, and especially on the backdrop of could it be in a situation where we're looking for high for longer? Remember, I say high for longer, not higher for longer, to some extent answering your question in terms of whether we could go higher. So looking back, if you're looking for a high for longer situation, high yield actually do look fairly constructive on the back of that. And that's why you see kind of the US high yield, European high yield all getting a little bit of kind of a bullish trade on the back as well.
Which sectors of high yield in particular are you looking at more favorably?
Yeah, so in Asia, we used to have a lot of property. Now, majority of the Asian high yield would probably be the banks. You have a lot of diversified choices, banks from Thailand, China, Hong Kong, Indonesia, India, or even to some extent you can look for some financial paper from Japan as well. So there's a fairly broad diversification available when you look at the bank papers. And of course, Macau gaming has become a fairly significant part of it. And you've seen the data coming through. It's still quite strong, still quite resilient. And then there's a lot of upgrade that's been kind of done on the Macau gaming side as well, which we're still comfortable with where the credit is, but valuation could probably getting a little bit too tight at the moment.
Yeah, well, how tight would too tight be generally on Asian high yield, for example? Because yield compression there has been significant.
Yes. I think overall, not just on Asian high yield, but if you look at across fixed income, you see spreads have tightened quite a lot. Depends on the kind of different horizons. Some say it's tighter for the past 10 years, at the tightest level on the past 10 years. And this is why, on the back of the narrative of historically, if you look at 2023, there's a lot of discussion about potential recession. On the back of that, that's why a lot of the fixed income investors or investors are kind of a little bit skeptical about the fixed income trade because spreads are tightened and there's very less room for compression, but a lot more chances for spread widening. And given that kind of circumstances, investors tend to be a little bit skeptical about fixed income. But given some of the numbers that are coming through on the US economy, coming back to our macro data, is actually showing no landing or a soft landing scenario, which is the recession risks have kind of diminished, which is why I think the overall yield that provided by fixed income, even though spreads tighten, it does being kind of fairly attractive for investors thinking about fixed income.
Vanessa, always great to see you.
Thank you.
Vanessa Chan there, head of Asian fixed income investment directing at Fidelity International. Going into the open today, so we're just, 8 minutes away from the opening bell. Hang Seng Index, A50 futures, your CGBs, you have a 280 billion renminbi 2-tenor auction today. And dollar China slightly stronger on the back of maybe not as weak a fix as yesterday. 7.1133 against the US dollar. The open is 7 minutes away. This is the China show.
All right, about 5 minutes away from the open of mainland markets this morning. And actually, when you're taking a look at futures, we're pointing toward a little bit of weakness coming through. Actually, Gold Dragon Index as well overnight was a pretty steep drop for that as well. So it's not just the story, of course, of US inflation numbers and CPI as well from China coming up, plus PPI, but it's a story of a few different geopolitical factors. Firstly, you've got chips, for instance, in focus. We've got a Bloomberg Scoop saying that there could be more restrictions from the US on China's access to chips or chip technology for AI. So that's one story. Then you've also got possibly China EV names also in focus as well, because we've possibly got these tariffs coming from the EU this week. We know as well that China's already said that they're planning to push back here, but of course, watching those names, BYD indicated to drop their 1.5%. Solar stocks as well, because we've got leaders urging for further government intervention. Solar industry broadly, we've just seen so much overcapacity there, and a big question mark around how long those different suppliers can continue to mitigate those issues in the market. But that's the state of play there, as we said. Equities setting up for a little bit of weakness so far. But, of course, big things on the horizon, Dave, too.
Yeah, so in a couple of minutes, we'll get inflation out of China. In a couple of hours, the final CPI print out of Germany. And then we move into U.S. and India inflation at about 8 p.m., 8-ish local time. Well, 8-ish Hong Kong time to be more specific. And then it's the Fed conversation going into that, though. So to Belle's point, weakness coming through. And, you know, we took out two key moving averages over the last 2 days or so. And it's looking like the CSI 300 will be opening again below a key one today, which is the 200 moving average. Watch it closely, 4-day skid on that. Speaking of inflation, your forecasts are coming through on your screens. 20th straight month is what we're expecting on factory gate deflation, and really just maybe a slight pickup in consumer prices. You do have, of course, the basket. Things like pork prices picked up, of course, but the other parts of this basket have been muted, if not completely sideways. The open and the data coming up soon. This is Bloomberg.
Welcome back. You're watching the China show. We're counting down, of course, to the market opens, but also the outcome from what we get in those inflation numbers. We're expecting a further deceleration from the PPI side. We're not really expecting anything from the CPI side either in China. And broadly, you've got markets as well setting up for a bit of weakness here today. Yeah, there's some price action coming through as well. So we are set to open lower, 20 seconds to the opening bell. There's not a lot of volume. You're talking about this, right? No.
25% lighter than usual?
Yeah, of course. I mean, you've got just so much on the horizon in terms of other inflation prints. You've got the Fed coming up. I don't think many traders are going to be really willing to take major bets today.
No. Plus, it's very humid outside in Hong Kong.
Something else to just keep you on the sidelines.
Yeah, or keep you home. Hope you're wearing something light. There we go. Hong Kong is on your right. Shanghai is on your left. Shanghai on your markets. CSI 300 4-day losing streak. Make it 5 now if things stay along these lines. Bottom of your screens, of course, your big movers across, or the big stocks across your mainland benchmarks. 10-year yield, I should mention, we have a bond auction today in China. Thank you so much. 278 billion CGBs, 2 tenders today. We are also just getting the CPI price. I'll get to that in a moment here very, very quickly, though. Have a look at Hong Kong and how things are opening up, and we'll talk about the numbers. Belle, why don't you start with the inflation numbers? Yeah, well, I think we can kick off with CPI reading here. It's actually come in at 0.3, so a little bit, I know, disappointment, but it is less than what economists had been expecting of 0.4% gain. So it just tells you, again, as we said, that inflation pulse is very, very faint at this point in time. So that's the CPI reading there, as we said, coming in at 0.3, steady from the month prior. PPI side as well, we're still in that deflationary territory, 20th straight month now of contraction, but the reading coming in at negative 1.4%. Again, a little bit off the survey, it had been for minus 1.5, but Chinese inflation numbers really just telling us that deflationary pressure is still lingering in the country. It's, of course, a big concern for policymakers there. It certainly is, and, you know, we're just coming off conversations around the Dragon Boat. this long weekend, and so when you look at some of the spending that's come through, there's a reason I'm bringing this up. A lot of the travel operators have put in place discounts to get people to buy in.
And that actually could come up in the numbers that you're seeing, maybe perhaps slightly higher food prices, but things on services and that sort of spending is still in discounted territory. Yeah,
it certainly is. I think it's come up regularly on. We have Joey Watt of Yum China on quite regularly, and she's always talking about how across their restaurants, Pizza Hut, KFC in China, it's really all about promos and bundling, right? So that is I guess in some ways, your deflationary pressure coming through in these markets as well. So it's not just this inflation front coming through. So we have a couple of things coming through as well. The 24 hours of duress, is that a way good to put that here? Next 24 hours, here's how things look. German CPI, the final print is coming out at about mid-afternoon Hong Kong. Then we move into, of course, where you are, India. 30 minutes after that, it's the inflation print out of the U.S., and then after FMOC starts scrambling following that inflation print, do they upgrade their own forecast based on what that comes out in? It's a Fed decision, the new dots, and then, of course, a press briefing coming out of the man himself, Jay Powell. There we go.
Yeah, really a lot for us to get through. But let's get more on this now. Bring in Sara Naison-Tarajano. She's Global Head of Private Wealth Management Capital Markets at Goldman Sachs. And Sarah, you are focused on family offices in particular, but how do you sort of advise in this sort of environment when you do have a lot of volatility and a lot of uncertainty, not just around what the Fed's doing when we could see cuts, but also when you're in a US election year as well?
Yeah, it's a great question. Thanks so much for having me. Look, I would say that in general, most of our clients within private wealth, and particularly, I lead our global family office business, Goldman Sachs Apex, they're quite long-term investors. And I think from a long-term investing perspective, we continue to be risk on, right? So our clients are generally long equities. They tend to have actually quite significant allocation to alternatives. In our global family office survey, actually, they revealed a 44% allocation to alternatives. And when we think about, the global equity market, you go back and our investment strategy group has done a lot of work on this, and particularly the U.S. markets where our clients tend to be quite a bit overweight have, beat inflation on a rolling 20-year basis consistently since 1926. And so I think how we advise clients is you want to stay along the markets. That doesn't mean equity markets, will come back, particularly when you're talking about U.S. markets. That doesn't mean that you don't think about risks in the market. And I actually think now we're at an interesting point in time where we are seeing incredibly low volatility levels. Obviously, the market has had a tremendous run this year. But, I've been in this business for 25 years. We're at least, a standard deviation below the sort of normal put volatility for S&P puts. And you think about what's going on in the world, you think about elections, it feels like the right trade is to stay long your equities, but to really think about adding, inexpensive protection to stomach, what may be some volatility coming into the summer, going into the U.S. election. And if you're wrong and the market keeps going up, you purchased an insurance policy, right? And so I think that's a lot of the conversations we're having right now. What's the timing of that? Is it going to be on the debates in June? Is it going to be closer to the election? And I think the answer is you can think about that, in a number of different ways. And we're advising clients to be thoughtful about adding protection here.
Right. In terms of protection, would that be in the form? I mean, the VIX is at 12, so it's extremely cheap to do that. You mentioned alternatives too. Is that some way too that people are building in protection? Just the increasing the uncorrelated part of their portfolio?
Yeah, look, I think increasing the uncorrelated, but also the correlated part of their portfolio. I think that, clients really, and particularly when you talk about family offices who have a lot of experience with illiquid assets, and they're comfortable with that illiquidity. I think that's the risk of alternatives is that they're not liquid when you need them to be. And so you have to be really thoughtful about having enough liquidity, enough cash, enough access to capital, ensuring you're not overly levered, which is something, we spend quite a bit of time on too. But alternatives really have outperformed public markets. I mean, look at something like buyout strategies, right? Top performing buyout strategies have outperformed the MSCI World over the last 20 years by close to 12% per annum. And so I think clients are interested in where they can create interesting access to alternatives, themes that take longer to play out. Doing it in the kind of the private equity part of the market that doesn't mark to market every day and have that volatility is a place where people spend time and are thoughtful about where to gain exposure.
Yeah, just maybe shed a bit more light on that, because private equity, but there's a lot of different alternatives out there. So which ones do you look at in particular?
Yeah, and so we look at all of them. I mean, our perspective is that you should have a diversified alternatives portfolio. And, there's, buyout private equity, there's growth private equity, private credit has gotten a lot of attention this year, as you can imagine, for many different reasons. I mean, the interest rate environment is the top reason, right? So you're getting into really double-digit returns in our direct lending strategies, which I think is quite interesting to clients higher up on the cap stack, better governance rights. And I think private credit is an area where historically our clients have been actually quite underweight. I think there are a number of reasons for that. The low interest rate environment that we have come out of is definitely a part of that, but also because so many of our wealth creators have made their wealth through concentration in both public and private equities, and so it's not a place where they naturally spend as much time. So we've definitely seen, and then regulatory changes with less lending coming from banks in that space and more from private credit managers and our clients too. So that's been a real theme. We generally, spend a lot of time advising clients to build a well-diversified alternatives portfolio. And it's also really important that with an alts portfolio, you really think about the vintaging of it, that you have a disciplined approach where you're allocating a certain amount of capital every single year, because nobody can necessarily have predicted a 21 or a 22. And if you had put all your eggs in a basket, in one of those years, it would have worked out fine. But in others, not so much. So really, thinking about being very disciplined across how to build a private portfolio over time in the alt space.
You mentioned at the onset, the money that you guys look after, it's multi-generational. So I guess it helps that you have an extremely long
That's right.
Time horizon in these things. So, these big pockets of money, extremely long time horizons.
That's right.
What does that piece of the pie look like? Is that almost half of what they're sitting at? You mentioned something like 44%.
Yeah, so I think, for our average, more kind of larger, more institutionally professional managed family offices, they tend to look more like an endowment model with, close to 40, the number from our survey was 44% in alternatives. Yeah. I think it is multi-generational. Liquidity is less important. And then there's also just shifts in the public markets. I mean, I started at Goldman Sachs in 1999. There are 36% less public companies today than there were in 1999. And there has been a lot more capital made in the private markets. Companies are staying private longer. They're getting to significant valuations in the private markets. There's even liquidity available in the private markets through secondary trading, which we're quite involved in as well at Goldman Sachs. And so, I think the dynamics of the markets have shifted as well there. And so, we definitely see a significant allocation to alts.
Do you notice a difference in preferences? Because you're here in town, of course, and I assume you're meeting some clients. So between, family offices side of the world, where you are, of course, in the U.S. in terms of preferences. There's always a home bias, for example, in terms of markets. So just what are your thoughts on that? What are you seeing? Yeah,
I mean, I'm going to talk a little bit about more what they have in common to start. And I think what they have in common is this concept that we spoke about, is that at family office level, you're not answering to a group of investors. You're not dealing with things like redemption. I mean, you're answering to your family, which is a whole other dynamic.
Exactly. Which is harder, actually, if it's grandpa and grandma, isn't it?
It's a whole different dynamic, but it means you can be more patient, and it tends to mean, what I think is pretty consistent about our family office community is that they actually run into the markets when others are running away. So the dislocation we saw in April, clients were risk on. And I actually think, we had a number of Asia family offices at our global symposium that we had in May. And actually in that survey, we had 53% of our clients adding to equity risk in May, saying they were going to be adding to equity risk this year, and 60% saying they were going to add to private equity. And so I think that this concept that family offices have of being quite comfortable with risk, as I said, many have made their money through concentration, and so being quite comfortable with being long the market more generally and stomaching that volatility, I think is one theme that holds true for our global family offices. And the other, and I would say that the thing that we focus on a lot with clients, is the biggest destruction of wealth is permanent loss. And so how do you avoid permanent loss? You avoid permanent loss by not being a forced seller. And so that's something we're really focused on with our clients. So being thoughtful about when you enter and exit the markets, being thoughtful about protection, being thoughtful about not putting on so much leverage so that you're going to be a forced seller in times of distress. You want to be the person that can actually enter the market in a time of distress, not being a forced seller.
Yeah, of course, being able to weather a variety of different storms. So in terms of the market allocation, though, of course, a lot of investors have continued to prefer the US, and we've seen that US exceptionalism. But are there any markets in Asia that you're more favorable on?
Absolutely. And look, I would say, our clients all over the globe are they're global clients, so they may have an over-allocation to the US, but I think Japan has gained quite a bit of attention this year with our Asia clients as well. Couple dynamics to that. One is just the equity market. If you really dig in and think about the dynamics of the Japanese equity market, that only 13% of households are invested in the equity market. That's 40% in the U.S. That's a big difference, right? There's been shareholder reforms and other things that I think, and most of our clients are doing Japan equities on a currency hedge basis. That's important to note. So I think Japan has been an area of focus. And then for a lot of our clients here in the region, just given the depreciation in the yen, actually looking at illiquid and hard assets to invest in Japan, if you're more kind of generally bullish on the overall economy, but the yen has obviously gotten beat up. That's a theme. India has been a theme, I think, with the recent pullback around the elections. That's been an area where people have been a bit more focused as well. And then I would say, as it relates to China, I think, many of our clients here already have a lot of exposure to China. But when I think about our U.S. clients, I think they look for pullbacks, often things like call options to play the equity markets, both mega cap tech here, A shares. And I think that's a theme that resonates. And I think people are trying to, obviously, AI has been a tremendous theme for the year, and think about what that means for this region, and really focused on the companies that have strong balance sheets and are going to be long-term winners in the space.
It's nice to see you. Have a great time at the conference. Then let's run this back when you're back in town. Sara.
Thank you so much. I really loved being here with you both.
Thank you so much. Sara Naison-Tarajano, there, Global Head of Private Wealth Management, Capital Markets at Goldman Sachs. Okay, very quickly, 13 minutes into the cash market session. A couple of movers to tell you about very quickly. 21% down, NEV. Some of the units have been ordered to return some of the subsidies. The government orders on the back of that news here. So the company said some of its unidentified units were ordered by some local government agencies to return about 2 billion renminbi in incentives and subsidies within 2 weeks. Okay, very quickly, EV stocks could come today, could come as soon as at some point this week. Higher tariffs in Europe, and of course we're looking at some of these solar plays, of course, and some of the chip stocks in focus on the back of that Bloomberg Scoop. And in the interest of leaving you hanging, read about the Bloomberg Scoop on the Bloomberg Terminal. There we go. Plenty more ahead. You're watching The China Show.
Welcome back to The China Show, and turning to another scoop now. Bloomberg has learned that the Biden administration is considering further restrictions on China's access to AI chip technology. We're told officials are now targeting new hardware that's only just making its way into the market. Let's get more now with our North Asia tech editor, Debbie Wu, joining us from Taipei this morning. And Debbie, talk us through these restrictions here, because we're just seeing a further encroachment perhaps on China's access.
So clearly this is a move by the Biden administration to further restrict China's access to high-end chips. And what's happening is that the Biden officials are considering limiting China's access to so-called gate-all-around chips using the gate-all-around architecture. So this is the advanced chip design architecture that TSMC is planning to start using with its 2 nanometer chips. So clearly this is a move to sort of curb China's efforts to have advanced chips. But it is unclear when these measures might be implemented. And probably equally importantly is that Biden officials are also considering, there's been early talks among the Biden administration that the U.S. is planning to restrict China's access to so-called high bandwidth memory chips. And this is important because these chips are necessary. They complement the AI accelerators made by the likes of NVIDIA and AMD. So if China wants to build its own AI chip capacity, it needs this so-called high bandwidth memory chips as well. And currently, only the likes of SK Hynix, Micron, and then Samsung Electronics have the capacity to make these most advanced HBM chips.
Yeah, Debbie, I'm very curious about HBM chips in particular because this is a very big cash generator for the likes of SK Hynix. Yeah. Samsung is trying to catch up here. TSMC is also supposed to be producing these new AI chip technology. There's a lot of different non-US players that are in this. So what's the patience here and the amount of bandwidth from these companies outside of the US to accept further restrictions?
Yeah, so we have seen that the way that the U.S. has demanded or asked foreign companies not to provide China with the advanced chips is the fact that these companies, including TSMC and SK Hynix, they all use U.S. technology, U.S. chip-making equipment to make these chips. So by relying on U.S. technology, this gives the U.S. government tools and then leeway to ask these companies not to provide China with their latest technology. Otherwise, Washington have the space to penalize these companies, maybe by saying that, well, if you don't cooperate with us, then we could curb your access to U.S. technology too. And then without U.S. technology, these chip makers' capability to make chips will be affected. Of course, I mean, we haven't seen something as drastic as that as have happened because TSMC, SK Hynix, Samsung, they have all been abiding by U.S. export control measures.
Debbie, thank you so much for getting us up to speed here on certainly the nuances, if not more important than the actual headline here. Debbie Wu, our North Asia tech editor, just taking us through the latest on what we know so far on what is being considered. Right, we'll leave you with a look at markets as we go into this short break. We'll be back on the other side of it. We're now below 18,000 on the Hang Seng Index. This is Bloomberg. Right, welcome back to the show. Just a recap of the May inflation numbers out of China came out about 20 minutes back here. So PPI actually coming in not as bad as expected. So in terms of the contraction, still in contraction, obviously 28th straight month, but lesser so. So 1.4% negative there. CPI coming through at 0.3%. Same headline inflation from April. Didn't come in as high as forecast of 0.4%, so missing ever so slightly on the median, but still within, I guess, the range of reasonable forecasts when you do a bell curve. But yeah, that being said, though, it's risk averse out there given not just this, there's a lot of event risk out there, Belle, today.
Yeah, that's right. But you are, of course, seeing that drop there for the Hang Seng down 1.4%. Let's shift to today's big take as well, because we've seen a series of recent scandals that have forced authorities in Singapore to ramp up scrutiny of family offices. Today's big take tells us that those in the industry are also stepping up oversight as the family office space attracts alleged imposters. For more, let's bring in our Asia investing reporter, David Ramley in Singapore. And David, yeah, this is quite a curious story today because we've actually seen just such explosion in family offices, not only in Singapore. Hong Kong's doing a lot to attract family offices and family wealth as well. Is that contributing to the problem here, do you think? What is the problem exactly?
I think the problem is, like any industry that experiences a huge amount of growth in both interest and in capital flows, you're always going to get a mix of players. You'll have the real and you'll have the not so real. We've seen it in AI, we've seen it in crypto, and now we're seeing it in family office. I think one of the key differences is a lot of governments around the world are really rolling out the red carpet, be it tax treatments or even golden visas, in an effort to attract the space. And that's something that's a little unprecedented.
Okay, well, tell me this then. I mean, the analogy I can think of when you have these fakers is, sometimes you have happy hour, there's a gathering of people, someone always makes it in that doesn't belong, and, you just eventually ignore them. and they sort of die into the darkness and maybe step out of the bar. So I'm wondering, David, what's the big deal if you have, one or two that are out of the blue?
Well, I think the risk becomes multifold. One is that it's not just one or two. One is that it starts growing exponentially as you have more and more people coming along.
Okay,
and
David, sorry, we have to cut you. My apologies. David Ramley there over in Singapore.
Welcome back to the China Show. Here's a look at how the Hang Seng is trading half an hour into the session. And as you said, Dave, we're below that key 18,000 level, and it's just a risk aversion that's really building into the session so far. The 8 shares index there down 1.2%, but certainly there's a lot of possible event risk. We've had those US inflation numbers ahead, but CPI numbers just out from China as well, PPI. Plus, you've got geopolitical concerns on the radar as well, EVs, chip stocks as well to watch.
Yeah, I mean, you'll see that in a moment when you look at, this broad swathe of losses we're seeing across the EV space in China, which is quite surprising because we knew anyway that these were coming at some point this week, right? Now, to what extent we're going to get the tariffs coming up, and certainly to what extent we then get margin compression, I guess, when you look at some of these EV plays in China. We can look at analysis in a moment here. 1.1%, as Bell was pointing out. We've taken out 18,000 on the Hang Seng Index. As promised, EV stocks on your focus coming up very, very shortly right now. So things like Li Auto, XPeng, leading some of the losses here we're seeing. There we go, in the order of 8%. In the case of NIO, 1.7% on BYD.
You wonder, though, maybe also just the risk of competition here as well, how much that's playing into it, because there's just so many different EV makers and models that are coming onto the market, and we continue to talk about the possibility for further consolidation as well in the sector, so perhaps playing into the declines.
That, and of course, what's been happening also in Europe has inadvertently, there's a mechanical dynamic at play as far as markets go, right? The weakness we're seeing in the euro is pushing up the US dollar, perhaps even stronger than where it should be. So that's creating all sorts of fluctuations. Dollar China, for example, I'll talk about you in a moment here. No, we are flirting with the lowest levels of the year on the Chinese currency. On the offshore rate, we're very near. On the onshore rate, we were there yesterday. We are seeing at least some green on your screens here as far as futures and European assets go, but it's been terrible really as far as French assets go, right? 2 days of weakness in the equity market. The banks have been sold off substantially. SocGen is down 12% Monday and Tuesday. So watch this very, very closely as well as we move into, of course, Europe. And speaking of Europe, by the way, we have Germany coming out with final inflation print later today. Just keep that in mind. Asia ex-China, we're looking at that as well. So on price, weaker. It's really in the lack of volumes that speaks volumes, if you will, on the risk aversion out there, given just the event risk out there on the table today.
Yeah, well, actually, I'm just taking a look at trading volumes right now, and they're pretty much down for every major market today, given, of course, as we said, really just that wait and see ahead of those key events that are coming up. US inflation print really the key one to watch, and how much that feeds into the FOMC decision, because we've got that due out later, and whether it sets the stage. Perhaps we do see that further weakness coming through, but of course it's against the backdrop as well of that labour numbers, surprising strength there, so a bit of a mixed picture perhaps as well in the US economy.
Yeah. In fact, let's get the take right now from Morgan Stanley on ahead of the Fed decision coming through as well. Likely no move today. It's really going to be context and what Jay Powell said at the press briefing. It's what the dots look like. Any change there, what the dots look like for next year. Let's bring in, from the Morgan Stanley Australia Summit in Sydney taking place, where we welcome, of course, our first guest this hour, Chief Global Economist Seth Carpenter. Seth, welcome to the region. Thanks for making time for us today. What a time, though, what a day to be having this conversation, Seth. I was hoping we could start off with the Fed and your views on inflation. Seth, what do you think the new dots are going to show us?
Yeah, thanks for having me here. The new dots. Our baseline is that the dots are going to show the median FOMC participant looking for 2 cuts this year. I think what's going to be even more interesting there is how much dispersion you're going to have to see around that. What's funny about the dots, and I was there at the Fed in 2012 when they were first introduced, each individual FOMC participant gets to write down what they think is appropriate, but they each also get to have their own view about how the economy is evolving, how inflation is evolving, and so it's very hard to get a clear signal. But we do think 2 dots for the median is the most likely outcome.
And so the expectation around cuts, when would you see the first one being priced in, or when would the first one come?
Yeah, exactly. So I think this is one place where this evening, from an Australia perspective, this evening's data on the CPI is going to be important, but also the next several months' worth. So we are a little bit out of step with where the market is. The market's looking for maybe 1.5 cuts this year. Like I said, the Fed dots, we're probably expecting them to say 2. We're actually currently expecting it there to be 3. So what would change that? What would bring that reality to where the market is and where the Fed is? And for me, that really does come down to the CPI data from tonight's data, the next couple of months. We think the trend is very clearly to the downside. We think the market's going to have to keep revising even more down its expectation for where inflation is going. But maybe as important, just as we get those prints coming out, it's going to mean that markets are going to say, boy, that upside risk, that tail of inflation going higher that we have to worry about, that gets eliminated. And we think once that uncertainty gets eliminated, that's what really allows the market to reprice and come back in line with what we think is the ultimate outcome, which is 3 cuts this year.
Seth, the notion that maybe the forecast of 3 somehow maybe underscores that somewhat. The notion that U.S. data deteriorates suddenly, and as we turn a hard corner, are there any early signs that may be the case in 2, maybe 3 months from now?
Well, I think that's really one of the key things from our perspective is we're actually pretty constructive about the real side of the economy. We think growth holds up reasonably well. We think the driver for the Fed this year to come off of this peak policy rate is just about the inflationary outcome. And if we just look at last month's CPI print, it was sort of very benign. If we look at the one the month before, it also was somewhat benign compared to the noise that we saw in the first quarter of the year. So what we think we need to see is just a couple more months that make clear that the high inflation prints that we got in the first quarter of the year, that was the noise, not the signal. And we're looking for a continued downward trend in inflation, and we think it's that lower inflationary trend that allows the Fed to come off its peak in policy rates.
The peak, of course, has been tested a little bit, that notion around Fed cuts by the latest jobs numbers as well, because we had that really robust print coming out at the end of last week.
Yeah.
There are 2 different parts to that survey. There's the side from the businesses, and there's also the side from the households, and we are seeing that divergence there. Are you tracking that at all, and what we're seeing from households in particular, given that by its own measure, there was actually quite a big drop in jobs?
No, I think it's first order important. The labor market is the most important market in the economy. I think in current circumstances, the establishment survey, the non-farm payrolls number itself, that's much more important and a much better read. Remember, right now for the U.S., we've had this large wave of immigration into the country, which has had this huge boost to the job market, to the labor supply. To use Chair Powell's words, it's a bigger economy, not a tighter economy. The challenge with the household survey is that it has to be benchmarked back to their best guess, their underlying population data, and those data don't include all of the new information on the immigration. So I think we're at a place where the household survey, which has historically just been much more noisy than the establishment survey, I think in current times it's even less reliable as an indicator. So I look at the non-farm payrolls number. It was strong. I think the underlying U.S. economy is sound. It's the inflation data coming down that's going to let the Fed come off the peak.
Seth, do you think the Fed wants to cut?
I do think so. I think primarily the Fed is very attentive to the idea that they've got this dual mandate from the Congress. They want to see just how much employment they can keep creating in the economy. They want to extend the cycle, but they really, really, really want inflation to be just decisively on a trend towards 2%. And so as long as inflation is decisively on a downward trend and they can feel comfortable about achieving that part of their mandate, they're going to want to do everything they can to allow this expansion to continue for as long as possible.
There's optics, though, at play here, too, around the U.S. election in particular. How do you think that that's going to play into the Fed path ahead, and also the outlook as well for fiscal spending?
Yeah, no, I think you can never ignore the fact that politics is there. My experience, though, so I was at the Fed for 15 years. I was there for the 2000 election, 2004, 2008, 2012. The institution tries very hard to adhere to its objectives of being nonpartisan, of being non-political. They really do try to look very carefully at the data. And during the elections, while I was there working on policy briefings to the committee, that was exactly how the institution functioned. I think now, though, we have an election. It's likely to be contentious. But again, if the data are pointing decisively toward lower inflation, like we think it is, it would also feel uncomfortable or awkward if they don't react to the incoming data. So I think at the end of the day, the fact of the election might heighten scrutiny on the Fed, but I don't think it changes fundamentally what they end up doing.
Seth, just to broaden out the conversation, we've seen global PMIs, not across the board, but I think the majority of that, the data that's come through recently have started to pick up. And I'm wondering what you make of the data, and you and your team. And are we on the cusp of a pickup, maybe a manufacturing boom? How would you describe what's going on?
Absolutely. I think the first point is that we're coming to an inflection point, right? We had the recovery from COVID, we had the high inflation rates, we had central banks start to hike rates. Now we're settling into a new normal, but it's happening in different ways in different parts of the U.S. economy. It's happening in different ways across different economies around the world. I would say for the euro area, for example, we are not looking for particularly robust growth. We're looking for growth that's softer than what we have in the U.S., but we think it's pretty clear that growth there has bottomed, and we're starting to have this very gradual recovery in the expansion in Europe. In the U.S., it's actually a little bit different. Services are holding in reasonably strongly, but it's clear that monetary policy is doing its job to some degree, and we've seen durable goods spending negative quarter on quarter for the first quarter's data, and there's a little bit less strength in the U.S. manufacturing PMIs if you compare them to services. So I think it's a real nuanced, complicated story across economies. Overall, though, to take a step back, we are constructive about the path for growth for the global economy. We think developed market economies will see inflation continue to trend down, DM central banks being able to cut rates, and we're looking for continued expansion this year and next.
Of course, Japan is the notable outlier in that sort of scenario. Do you think that there's enough signals now that really to see that Japan has exited from deflationary territory? Are you confident in the inflation outlook there, sustaining the BOJ's path toward hiking?
I am very confident there. So it's great being here in Sydney at the Morgan Stanley Summit in Australia. About a month ago, I was at our summit in Tokyo, and I can tell you there the feeling was very alive, very electric. The energy was palpable. A year ago, we first started writing about an end to the deflationary regime and a fundamental shift in equilibrium towards growth. It was tentative then. Lots of skepticism from markets, lots of skepticism from clients. I can say now, almost all of the data have come in the direction that we're looking for. There's a virtuous cycle between higher inflation, and now we saw the spring wage negotiations much higher than we've seen in a long time. As those wage increases filter through the economy, it allows consumers to keep spending, which allows businesses to keep the higher prices, which then allows them to pay those higher wages. And so we have shifted. I feel very confident that we have gone to a brand new equilibrium, leaving a couple of decades, in fact, in the rearview mirror.
Seth, again, it was nice to see you in the region and have a great conference ahead. There's Seth Carpenter, the chief global economist at Morgan Stanley. Right, so just ahead here on shows, we'll be crunching the latest inflation prints out of China with Bloomberg Economics, their take there. And also we'll hear why they think a lottery boom on the mainland might be a troubling leading economic indicator. More on those stories and angles just ahead. You're watching The China Show.
Well, China's consumer prices edged higher in May, but factory gate prices remain stuck in deflation as they've been since 2022. That's the 20th straight month we've seen for those PPI readings in negative territory. But let's get more on that now with our Bloomberg economist, Eric Ju, joining us in the studio. And Eric, are there any positives to take away from these numbers?
I think the good news is probably China is out of deflation, right? We have seen at least a positive inflation for the several past months. But I think the bad news is that the inflation is not flying anywhere. So it's still very low, just barely above zero. So that means the underlying demand, still very weak in China. That's our reading.
Before we move on, what's your outlook for inflation? Because in a couple of months, the base effects start to become favorable.
Yeah, I think in the second half of the year, probably we're going to see continue some mild pickup in inflation because it's largely due to, the deflation period in the second half of last year. So, but I think probably the core demand, the key gauge will coming from the core inflation, core CPI inflation. So that would be a best signal to see whether we see some improvement in the demand side.
Of course, some of the demand side is being driven by PBOC policy as well. Do we see any sort of shift to that in the months ahead as well?
Yeah, I think we do see a window that for PBOC to further easing, probably as soon as this month, because after the ECB cut the rate. So I think PBOC would provide some opportunity for PBOC to pull the trigger because it's no longer the first major central bank to cut the rates. So we do think that there's some possibility for PBOC to cut rates next week.
Your latest note, I'm going to read it out, makes sense. Help us make sense of this. Lottery boom plus marriage bust equals low confidence.
Yeah.
What does it mean?
I think that's another kind of indicator we're looking for to show why, the demand is so low, why the people, the price is so low, why the confidence is so low, because you've heard lots of people talking about China facing a confidence crisis. So we do think we find some indicators. One is the lottery, which is picking up very fast after the pandemic. So the other thing is if you look at the marriage rates, that's also kind of declining, even faster after pandemic. So if you map the two things together, especially if we look at provincial data, it's quite interesting that for those areas which we see higher growth in lottery sales, it's actually seeing a lower marriage rates. So that could mean some low confidence is playing a role, in leading to both directions. Right? That's some interesting finding. We would say that's probably a signal that the young people are now lying flat without giving up some hope of working hard can make you make you a good future, right? So they resort to more like a lottery playing lottery and just trying to use that as an affordable way to relax and to
look good.
Stress. Yeah.
And to look good. Eric, thank you so much. Eric Ju, out of Bloomberg Economics there. Right, plenty more ahead. We'll leave you to look at markets. We're now down 1.7% on this Hang Seng Index. CSI 300, 10th of 1%, fifth straight day of weakness on the onshore benchmark. Kospi Index going the opposite way, a third of 1%. There we go. Plenty more ahead. This is Bloomberg. You're watching The China Show. Premier Li Qiang is set to become the most senior Chinese leader to visit Australia in 7 years when he arrives the coming weekend. The Foreign Ministry has confirmed the 4-day trip, which comes as warming ties face a challenge from renewed frictions over investment and military deployments.
Yeah, a really big story, and of course we've really tracked those tensions between Beijing and also Canberra. But speaking exclusively to Bloomberg, the Australian Treasurer Jim Chalmers explains why that relationship is a complex one to manage.
This is an incredibly important economic relationship for Australia. And Premier Lee's visit will be a really welcome opportunity for us to continue to engage, to continue to stabilise a relationship which has no shortage of challenges and complexities. It can be a complex relationship to manage, but what we've shown, I think, in the last 2 years is that by engaging, by standing up for our interests when it's necessary to do so, but also looking for ways to engage and stabilise the relationship, there can be good economic dividends from that. We're very pleased to see almost all of the trade restrictions lifted over the past couple of years. That's important for our employers and our industries and our exporters. We recognise and understand how important that economic relationship is, and Premier Lee's visit will be an opportunity to advance that even further.
We were talking about the inflation numbers for China, and obviously for Australia, we're closely watching the developments when it comes to the economic recovery. What we hope is an economic recovery. Do you think the recovery is on foot? Do you think the property sector is at least out of structural levels of direness that we've seen? And do you think that translates to still a longer-term demand for Australian commodities?
Oh, well, certainly we've acknowledged and understood and felt some of the weakness in the Chinese economy in recent times, recent quarters. And that won't fix itself overnight. You know, even with some of the interventions by the authorities, you know, we're still seeing some underlying weakness in the Chinese economy, and that does impact on our commodity prices and on our economy more broadly. So we watch that very closely. If you think about the global economy, it's a mixed bag. China has been a bit weaker. The American economy has been a bit stronger. Canada's got higher unemployment. Europe has seen almost no growth, and so altogether, this is a difficult global environment to navigate, and again, it's why it's so important. We engage with our trading partners, we get the budget in better nick to buffer ourselves against this global uncertainty. We fight inflation without smashing growth. All of these conditions we're seeing around the world and around our country justify the approach that we've taken in our budget.
There's been quite a bit of interest around Northern Minerals and the shareholders thereof. How much do you engage with, or I suppose how do you engage with China when it comes to strategic minerals, given that we know that the Premier is likely to visit a lithium mine in WA?
Yeah, I mean, we've been very upfront about our interests here, and where we need to advance our interests, we'll do so, whether it's in the Foreign Investment Review Board process or in other ways. We see critical minerals really as the opportunity of a century for Australia. There's a lot of interest from around the world, not just from China, in our critical minerals, and that's because they are such a crucial part of the future economy. And so my job, in addition to engaging with the Chinese, and in addition to making sure that our foreign investment regime is robust and implemented properly, is to make sure we make the most of this critical minerals opportunity. We want to make Australia an indispensable part of the global shift to net zero, this big energy transformation that's happening around the world, and critical minerals are an important part of that.
China could make or break that, though, if you take a look at the Indonesian nickel impact on Australia's nickel boom, of course. If you can't beat them, do you join them? Do you work together with Beijing?
Obviously, there have been some concerning developments in the global nickel market, you know, we've been upfront about that as well. We engage with our own exporters and employers, businesses substantially on that question. We want to make sure that these global markets for critical resources are operating efficiently, and we want to make sure that Australia is a successful part of that.
And that was the Australian Treasurer Jim Chalmers speaking exclusively with our colleague, of course, there in Oz, Heidi Stroud-Watts. Right. Plenty more ahead. Look at markets, some of the big movers in this equity market. So big downdraft we're seeing in the chip space, EVs, and also financials. On that scoop that China may be looking to limit the bank's ability to sell hedge fund products. More on that story in a moment. This is Bloomberg. Oh, did she? Can you tell her I said hi?
All All right, it's 11:29 a.m. if you're watching in Tokyo, and Tokyo traders just under a minute away from their lunch breaks actually in the session today. Japan stocks really standing out for the weakness we're seeing here. Of course, lower trading volumes ahead of some key risk events, U.S. inflation, Fed meeting conclusion rather coming up ahead, but pretty much every sector is sitting in the red today, and some of those, of course, more sensitive to interest rates, the likes of consumer discretionary, real estate, financials. What is standing out, though, to the upside is actually the energy space so far, and we have seen oil holding on to some of its recent gains, Dave.
Yeah, which is maybe lifting some other pockets of this market, but as you point out, right, so in terms of negative breadth, that's fairly consistent with the risk of a recession. When you look at volumes, people stepping even away from this market today. Just to give you a stat on that, right now we're about 23.6% lighter on volumes, Asia ex-Japan, compared to your 30-day average. As far as that's concerned. Right, so on price, we're down 0.4%. Couple of movers to tell you about here. Financials in China. Seeing some downside today. Might have to do with our Bloomberg Scoop, which came out about 2 hours back at this point now, that China is weighing this ban on banks distributing and selling hedge fund products. They're seeking feedback from on these revisions that would prohibit disguised quote-unquote selling. As our colleague in Beijing, John Leo, pointed out, it's a consultation period, but chances are we'll likely see these take effect. Right, chip stocks also in focus today, and that's also on another Bloomberg Scoop that the U.S. might be looking to widen some of the chip curbs to cover other sorts of technologies and high-end chips, which might affect more than the stocks you're seeing on your screens as well. The likes of SK Hynix, for example, would be also affected in the event, of course, that does take effect.
Yeah, well, there's a possibility it's expanded to include HBM chips, and that's been really one of the key money makers for SK Hynix, Samsung as well. But they're actually trading high. We've got the Apple news as well. Yeah, we did see that new fresh record. But let's get back to our coverage of the Morgan Stanley Australia Summit in Sydney. Our Asia Trade co-anchor Heidi Stroud-Watts is standing by with our next guest for a conversation on venture capital. Heidi.
Yeah, Belle, it's been a tough few years, certainly, but here's a man who knows a lot about that. Paul Bassat is the co-founder and partner at Square Peg Capital, which is Canva, Airwallex, Property Guru, amongst some of those early investments that were made in its portfolio. Always great to have you, Paul, and I think for the first time in person, even though we've spoken to you many times before throughout the pandemic remotely. What's exciting for you at the moment?
Yeah, look, I think, clearly, rise of AI, and that's not a news story, and it's a story that's going to be with us for the next 20 or 30 years, if not more, but it's going to be, I think, the defining theme of this era. So, we're in a new era of computing, which is always, incredibly fun, and I think as an investor it's both the most exciting time and the hardest time. If you look at the period, say 93, 94 to 1999, the rise of the internet era, 4 or 5 of the 12 largest companies in the world were founded during that brief period of time. And I think we're actually going to see a similar period. So we're going to see a pretty exciting new generation of businesses emerge. It's obviously a really complicated time, though, as an investor, as a founder, as you work out which business models are going to be successful and what part of the value chain to play in and what the moats look like and what the addressable markets look like. But it's going to be a really, as an investor, that's what you look forward to.
And in that early stage investing process, how are you identifying those opportunities?
Yeah, I think we're thinking it through a framework, sort of a, different framework. So the framework where, there's a sort of the horizontal framework and the vertical framework. And the horizontal framework is kind of, is anything from NVIDIA and chips, it's the large language models, it's the infrastructure players, it's the folks enabling the vertical applications to be deployed, and then there's the vertical layer, and that's across every market, every industry, whether it's healthcare, whether it's different sectors of healthcare, whether it's retail, whether it's legal services, whether it's accounting, whether it's investment banking. Across every vertical market, we're going to see lots of different players emerge who solve specific problems for that business. And I would say probably 70 or 80% of the time we're spending is in that vertical layer or the application layer, and the rest of the time, looking at businesses that are operating horizontally.
As you say, though, it is sort of worldview changing when it comes to that vertical layer. So how hard is it to be able to get visibility and to narrow down the opportunities?
I think it's hard. It's difficult. I think understanding how market's going to evolve and how market's going to play out. I think it requires a lot more first principle investing than, say, investing in software as a service business models where, we've been doing it for 12 years, where the market is, 20 plus years old. We've been investing now in AI businesses probably for 4 or 5 years. So we're building up a muscle. A lot of the, particularly in the vertical layer, a lot of the principles that apply to software as a service or traditional software models apply pretty well. They're solving a problem for a particular market. There's a question around why, what is the source of competitive advantage compared to the existing or the legacy players, what's the size of the moat, how big is the market, etc. And so there are principles you can apply, but there's also a lot of first principle thinking that you've got to bring to bear.
What are valuations looking like here across private markets? I mean, obviously you take a look at something like Nvidia and the ceaseless momentum that we see for these names in the public market. Is that petering through to what you're seeing? Yeah, I think, there's a couple of elements. One is, when we think about valuations, there's a relative lens and an absolute lens. And then there's a sort of, there's AI first business models and non-AI first business models. Clearly the AI part of the market is really hot. Valuations are higher than non-AI first businesses. We're going to see, lots of value created. We're going to see lots of businesses go to zero. That's the nature of startup markets, particularly at the start of a new era. Look, I think, the other thing about these businesses emerging and OpenAI, I think is a great case in point where I think it's reputed to have a couple of $1 billion of annualised revenue growing incredibly fast. The addressable markets are much, much bigger today. If you think about the rise of the internet when these businesses were emerging, their revenues were tiny, and they were tiny for a number of years. And they were growing really, really fast, but off tiny bases. And the size of the internet economy back in the late 90s was very, very small. Today, the size of these addressable markets are really, really large. And so you're seeing businesses sort of start with much more momentum and can grow into really significant businesses much more quickly. But no question, valuations in AI are more elevated than they are in the rest of the market. Yeah. Do you think that has also helped when it comes to countering otherwise what you see as more of a drag from the macroeconomic environment? For Australia, for example, do you see much of an impact of the fact that the RBA is largely seen as being behind the curve?
Yeah, look, I think we're seeing a couple of things. I mean, one of the things, particularly in terms of the inflation story is, and productivity story is, it's been one of the mysteries, obviously, of the last 20, 25 years is why we haven't seen strong productivity growth in Western economies. And there's lots of explanations for it, including that the measurements, kind of miss stuff and miss sort of consumer benefit that we get from technology. But the underlying story is that on traditional methods of measuring productivity, the story's been pretty depressing for basically a generation. And I think what we're seeing with AI, both for small business, for large enterprises, for government, for startups, is the ability to drive pretty remarkable productivity gains. That's going to create its own questions and own complexity around the future of work and what it means for employees and all sorts of really important societal questions. But one of the things I think we are going to see, if you take a sort of a 3 to 5 to 10 year view, perhaps not in the next 6 months, is we're going to see very, very significant productivity benefits, and that's obviously going to be an enormous enabler in terms of creating prosperity for society.
It's obviously been a pretty tricky past 12 months when it comes to venture investing, but also a lot of uncertainty when it comes to companies going to public markets as well, right? Do you feel like when it comes to the IPO window that Australia is ready for that to sort of reopen? Yeah, I mean, the IPO window is opening both in Australia and globally. It's been closed for a long time. I mean, this is, you think back, this is almost as long as the period sort of, post.com crash in April 2000. The window's been closed for a while. I think, one of the things that as windows reopen is companies, the incentive is for companies to say, I'm not going to be first, I'm not going to be one of the early ones. Clearly the reception of to GYG, who are, I think, going public next week, and I was just on a panel with Steve Marks. In terms of a local story, is an amazing story. Steve and his team have built a great business. It's a really good, really exciting story that may be a signalling in Australia. But globally, it's pretty clear that, quality companies that want to go public now, that window's open. How many of them choose to do it in the second half of this year and how many of them wait till 2025 and beyond remains to be seen.
but it is the window appears to be reopened.
Paul, really great to have you as always. Belle, Dave, I'm going to hand it back to you there. Paul Bassat here with me.
That was Heidi Stroud-Watts there in Sydney, and we've just had some breaking lines crossing the terminal here relating to the Segantii case, possibly a new court where it's going to be tried here. But let's bring in our China correspondent, Min Min Lo, who's outside the magistrates' court for us. And Min Min, it appears that we're going to have a new court now for this hearing.
That's right. The latest that we're hearing from our colleagues who are still inside the courthouse, they're saying that this case is going to be moved to the district court on July 2nd at 10:15 a.m. That's what we had expected and we had heard before from our sources as well. The district court will be able to hand out a harsher sentence of up to 7 years in prison as opposed to just up to 3 years in prison for the magistrates' court. And also, mind you, the district court has the highest conviction rate among the different levels of court. But still, the term that they can hand out is still going to be lower than the maximum penalty of 10 years in prison for a crime of insider trading. But our sources are saying that the prosecutor are not going to escalate this all the way to the High Court. So earlier this morning, we saw Daniel Rocca and Simon Sadler, the defendants of this case, arriving in person. Simon Sadler was a little late. He came together with the CEO, Kurt Ersoy. It was a very small courtroom, just 3 rows at the back of the courtroom that were nearly fully filled. Simon Sadler and LaRocca, they were not sitting together, and not a lot to report today, as I said, because there's no trial, no verdict. We'll have to wait and see what happens when the trial begins at the district court.
Min Min, thank you so much. Min Min Lo, there are China reporter just outside, of course, that court where things, of course, are shifting locations for July the 2nd. Right. In fact, we'll have more on the Segantii case next when Jingtian and Gongcheng partner Jimmy Chan joins us. He's a former division director at the Hong Kong Securities and Futures Commission, of course. So he's, let's say, he's fairly familiar with these proceedings. Plenty more ahead. This is Bloomberg.
Right, one of our top stories over the course of today, what happens with the Segantii case. Yeah. We've just had some breaking lines crossing the terminal here that the trial, the court case is now moving to the district court. That is set for July 2. The district court, of course, one that can carry or hand out longer prison or jail sentences to the tune of around 7 years. Insider trading, I think, is something that can carry a maximum penalty of around 10 years. But certainly something, of course, we're tracking this shift to a new court, that hearing set for July 2. Joining us now to discuss more on this is Jimmy Chan, partner at Jingtian and Gongcheng. He's also a former division director at the HKSFC. And Jimmy, just talk to us just broadly about the landscape for trialling these sorts of cases in the city. This case now, what does it tell you about how the SFC is sort of approaching this issue?
So the SFC has always been very serious about market trading cases, market misconduct, like insider trading, market manipulation. So the primary goal is to have criminal prosecution, because if you just find them, the financial practitioners may not be deterrent enough. But so they always want to impose jail and imprisonment terms on these financial practitioners. So this case will probably be the second biggest case before the district court. They prefer district court because district court has a highest conviction rate. And also the last case that was the biggest one was the Du Jun, MD of Stanley. He got 7 years from district court, and then later from appeal, he was reduced to 6 years. So criminal prosecution has always been the priority. Yeah.
So jail time, if I remember as well from the Morgan Stanley case, he was also ordered to pay a substantial amount of money. And I'm wondering, in terms of just the possibilities for the current defendants, for example, are they facing something similar apart from potential jail time.
Yes, that's correct. The SFC has many ways to deal with insider trading. Usually they would do the criminal prosecution first or the market misconduct tribunal proceeding, which is administrative proceedings, mainly targeting overseas people, like the Tiger Asia Bill Huang case. After the initial enforcement actions, they will may apply to the civil court for compensation orders. That means asking the defendants to disgorge the profit and then repay the investors. So that's possible after the criminal conviction.
And what sort of penalties would be attached to that, do you think?
So you mean the criminal prosecution or the compensation order?
Compensation.
Yeah, the civil, yeah.
The compensation
potential
order,
amounts.
Yes, they need to first have the conviction first. They have to quantify the profits earned by the defendants. Once they quantify the profits, and then they have to find out who are the counterparties to the insider trading.
Right.
So it takes a long time for them to quantify and then find out the counterparties and then repayment. That takes a couple of years usually.
Now, and going back to the criminal portion, if this does, of course, end up with a criminal case and a verdict, a guilty verdict, let's put it that way, how long would it take? Because July 2 is the next court date, I believe, and we're already moving to the district court. Typically, how average length of these cases, for example?
I think it takes months. It takes months because the prosecution need to prepare for the case and call the prosecution witnesses, usually the SFC investigators and other, maybe the firm's colleagues.
Right.
And then after that, they have to sort of call the defendants, examination in chief, cross-examination. So it may take months, especially I understand that they hired a London Silk, a London King's Counsel. So it will take time for them to prepare.
And you mentioned something interesting there. You know, the reason things are moved to the not the high court, the district court is because the conviction rate is higher there.
Yeah.
Why is the conviction rate higher?
It's just unknown, but through past statistics, district court got the highest rate. There's a possibility that because district court cases are heard by a judge alone. For the high court, because they have jury, sometimes you cannot really understand or expect how the jury will decide. But the judge usually, they're more sort of understand the insider trading, manipulation stuff, very difficult stuff. So I think that's why they have a higher conviction rate.
You mentioned as well the sentence for Jingtian from Morgan Stanley, who was the last previous case that you're looking at for this, that his sentence was lessened from 7 to 6 years. Why was that, and does that also set a sort of precedent here as well?
I think because he went to the Court of Appeal, and there was some factual issue, mitigating factors, and then the Court of Appeal judges decided to reduce the penalty. I think it's some mitigating factors. Yeah.
Jimmy, thank you so much.
Thank you.
That was great. Let's chat again. We're not finished here, of course. Jimmy Chan, partner at Jingtian and Gongcheng there. Yeah, plenty more ahead. Of course, in case you missed it, of course, they did move the case to district court. July 2 is the next date as well. We'll be giving you more details and more updates on this once we do, of course, get them. Plenty more ahead. This is Bloomberg.
Well, a series of recent scandals have forced authorities in Singapore to ramp up scrutiny of family offices. That's the focus of today's Big Take, and it tells us that those in the industry are also stepping up oversight as the family office space attracts alleged imposters. For more, let's bring in our Asia investing reporter David Ramley in Singapore. And Dave, it's quite colourful language, I guess, to talk about alleged imposters in the family office environment. Why is this the case? And is Singapore or Hong Kong, is this a particular market for attracting some fraudulent family offices as well?
Well, I think Asia, as the growth of next generation wealth goes up, and as governments ramp up the tax exemptions and the golden visas that they offer, the entire family office industry is really growing exponentially. We're seeing thousands where previously, just 5 years ago, you would have seen dozens of family offices in both Hong Kong and in Singapore. And that's only continuing to grow.
Right, and we've had, won't go into the details of this, but we have certainly high-profile examples of this. I come to mind, of course. That's an insider joke. But David, okay, so what if we have the fakers lingering in the corner, apart from, of course, they're probably taking the share of the cocktail that someone else should be taking? What does it mean in the bigger scheme of things?
I think the problem that you have is that family office generates this connotation of super wealth, both to governments and banks as well as to individual investors. So the so what here is that you're having potential fakes, potential scammers being given access, unprecedented access, that they wouldn't normally have purely because they have this label attached to them. And they're being introduced not just via their own channels or via cold emails and Nigerian print scammer methods, but from government agencies and even going ahead and meeting with senior government officials and being introduced to other families and potential victims that way. That's one of the key risks here.
David Ramley, thank you so much. David, our Asia investing reporter on today's Big Take, of course, and really this fantastic, I should say, David and your team, step back piece on the unexpected implications of this boom in the family office space. David Ramley in Singapore for us. Right, back to markets right now. 90 minutes into the cash market session here, and we could be a bad day or two away from entering a correction on the Hang Seng and Hang Seng China Enterprises Index. Both are now at about 8.5% down from the peak back in May 17, May 18. So that puts us about 1.5% from that sort of technical threshold of 10%. That said, Seokjin just came out and turned overweight on Chinese stocks from neutral.
Yeah, it's a really interesting one because you've just seen investors sort of hot and cold on Chinese equities. They were piling out, piling in, piling out. So this is sort of the fourth sort of different fluctuation we've seen just this year alone when it comes to Chinese stocks. But it seems like there's a lot of concern that's brewing around the health of China's economy once again. But important to note as well, because we were just speaking with Eric Ju earlier at Bloomberg Economist saying actually the inflation numbers could start to look better going into year end, even if there's just base effects that are also coming into the story as well. Yeah,
which is why context is important, as they say. And hopefully that's where we come in, become slightly more useful. E-commerce names bucking the overall trends on the back of more, perhaps more policy support on the way from authorities. So that's one pocket of this equity market that's doing well amidst this general sea of red out there. This is Bloomberg.